Yeah, hi, and welcome to the next episode of FINtastic Talks. It's great to have you there, and I always love to start with a gratitude. Thank you for taking out this time to watch this talk. And my, dream and belief is that if I'm able to help you on your path to let you live the life you deserve to live. Why do we invest? Why do we save money? It's not because of retirement, or it's not because of some date. Then why we are not living today? We are living, we are investing, so then one day we have a second income which is as good as taking care of our current income, and we can live our dreams. We can go where we want to go, we can do what we want to do, we can work the number of hours we want to work, and that gives us the financial freedom. So the whole purpose of this talk is to bring you to financial freedom. And today we have a very exciting talk, which has been very different to the other talks that we have had, is that we have never picked up the topic of stockbroking or how to trade in stocks. And people love to trade in stocks. That's they believe that's the exciting part. I want to do some stock picks, I want to sell some stocks, but the problem is that a lot of people do it with a lot of excitement, but unless you're not super disciplined, most of the people actually have a bad experience here. Take care, but that has changed over the period of time, and they are people who have learned how to do well in stocks. And that's the code we want to decipher today. We are very lucky to have with us Vijay Chandok, the MD and CEO of ICICI Direct. And he's a hardcore banker, and one of the people like from the genre of ICICI Bank, working in the same company since 1993. So we are very pleased to have you with us, Vijay.
Thank you very much, Sanjiv. A very good evening to all the viewers, listeners, and thanks a lot for having me on this show. Always a pleasure to have interaction of this nature. I think your programs are very interesting, and you're running it with a very noble intent. So very happy to be a part of this show.
Yeah, I think prosperity is best enjoyed when it's shared. And there is India, we are living in a time of opportunity. India is actually growing. It's a time for India. The whole world is looking at India. And India is the story where wealth creation is going to happen. And if you are just going to sit on the sides and not be a part of this wealth creation story, then what's the fun? Other day, I believe Indian markets can give even a 15% return. Normal salary grows at 7-8%. So even if you are putting some part of your salary into wealth creation over 10-15 years due to power of compounding, you're making 4-5 times more money. So that's the whole purpose of this show, the whole purpose of this talk. And Vijay, it's always amazing to see people like you. I've interacted with your peers. We get to work with each other, whether through ICICI Pru or one of the other companies. But I always admire the hardcore ICICI backbone of people like you who have stayed with one company for such a long time. I was looking at that you joined ICICI Bank in 1993, and you have stuck on to them for more than 30 years, which is phenomenal. And we have a lot of young people watching the talk who don't understand the power of commitment and power of working for one company. They believe that if I keep changing jobs, I'll have a great life. But they don't realize that once you spend more than 10-15 years in an organization, you're put into a different league and orbit, and you're always taken as an insider. So just tell us this story that, what has been your story, what made you stay with one organization for such a long time, and what has been your experience and what are your views on it?
Yeah, thanks a lot for being so generous, Sanjeev, with your words. Um, Actually, just to marginally correct you, yes, you were right in saying that 1993 is when I joined ICICI. You mentioned ICICI Bank. Actually, the reality is that in 1993, ICICI Bank didn't exist when I joined. So I actually joined even before the bank was formed. So I had joined ICICI Limited, the DFI of the day.
Okay.
If you recollect in those days. So I really belong to a different generation now compared to all your viewers and listeners. Yes, indeed. In fact, just as a bit of a backdrop, even before that, as far as my education is concerned, I'm actually an engineer. And after doing my engineering from IIT, I actually worked for the ITC group. In that capacity, first, straight as an engineer, I was actually into production and making cigarettes. I decided that cigarette making is not what I want to do. I wanted to get into the world of finance, so I did my MBA. And after doing my MBA, straight out of campus, I got a job offer from ICICI Limited. It was a very, I would say, coveted opportunity to work with a DFI like ICICI. It was a day one campus job, a dream job for many people who wanted to pursue a career in finance. And I was very fortunate to be selected by ICICI Limited. And people, while ICICI was never known as a organization which paid well, it was certainly known as an organization which could provide you a unparalleled career, unparalleled exposure into the world of finance. People would give their, if I can use the proverbial, right hand to get an experience of that nature. ICICI certainly belonged to that league. And true to, its sort of image of the day, when I joined ICICI, I was straight day zero, day one, as they call it, put onto the swimming pool without even knowing how to swim. Obviously, one is quite nervous and quite afraid of how are you going to manage the situation. But I realized that the seniors come to help you. Your colleagues who are also not necessarily your seniors, but maybe a little more experienced than you are, they chip in to suggest, guide, advice, or whatever, to keep so that you don't sink into the water, but you're actually able to float. And that's what happened to me. Day one, I was put onto a job where a portfolio was given to me. In those days, ICICI used to be doing doing project finance. So I was also obviously as a part of what the core business of ICICI used to be, which is project finance. I got into that role, and I just loved the job, because in the day, just think of it, I'm straight out of college. I have learned some concepts in college which are all theoretical, finance, debt equity ratio, interest coverage ratio, and so on and so forth. Probably a lot of it didn't make too much sense. And then when I started doing jobs, I realized that we had company owners coming and applying for loans to us. So here was a 1 year, 2 years straight out of college kind of a guy sitting in front of a owner of a large company, and the owner of a large company very painstakingly explaining his business model, very painstakingly explaining and convincing this young person on the other side that he's got a very good project, a very interesting project, and then it is fundable, explaining how the markets are going to absorb his product and so on and so forth. So it was an enormous exposure and learning opportunity for me, because I started understanding the way a business operates from the owner's eyes. And this is just 2 years, 1 year into the job. So this kind of a vantage view is really, really compelling. Very difficult to get that kind of a vantage view. You're straight getting the top-down view of an organization, how to think of a customer, how to think of an industry trend, how to think about growth rates, how to think about the risk factors. We never, as a normal person joining any organization would get that kind of a perspective. And you were actually then very quickly moving into a mode and telling him that, sir, you have miss these 3 points? What will happen if these happen? And it used to give a huge kick. So time passed very fast, it's doing that. And because I was enjoying, loving what I was doing, there was no need even to look outside. One of the philosophies which I do consider very important is that at the end of the day, it's very important to do what you're liking, what you're enjoying, what you feel good about. I never really was so mindful of the fact that where is my career headed as a consequence. I had the confidence that if I do a good job, if I'm enjoying the journey, if I'm liking what I'm doing, do I belong to an organization which is fair? Do I belong to a setup which has demonstrated that it can give career to professionals and individuals, and not necessarily belonging to a certain category or a certain coming from a certain privileged background? If the answer to that was yes, I realized that then what am I looking? Why do I need to look outside? I'm loving what I'm doing. I'm learning a lot. I'm getting an exposure which anyone would die for. And at the same time, I belong to a setup which values professionals, which gives an equal opportunity to people, and there is therefore very little reason for me to look outside. So time just kept passing by, and I kept realizing that I was rising through the ranks and through the system. So I would say that was one element which guided me through the initial part of the journey. But that said, I must also bring out another very, very important factor, which is, I would say, factor of luck. And this factor of luck cannot be discounted at all. And it so happened that they say, right, you should be at the right place at the right time. When I look back, it never sounded the way I'm speaking to you now back in the day. But ICICI was a startup of sorts in those days. It was in the context of where it is today, a very, very small setup. We were just about 1,200, 1,300 people. That's it. Out of that, the managerial staff was about 700. So it was a reasonably small setup. And, when there was the first change that we had at the leadership level, Mr. Kamath, the chairman who has been with the ICICI through the massive transformation over the more than a decade and a half, he had just come in and taken charge from Mr. Wagul as the chairman. And in his initial first year and a half of his entry, he started making some major changes within the system. He actually came out with a voluntary retirement program for some of the senior individuals. And in one shot, about 125 senior officials of the company took up that voluntary retirement program. So just think of it. I'm just 3 years into the system, and a very large set of seniors have sort of retired. And because of that, many of the juniors started getting sucked upwards. So I would simply say that we were lucky to be at the right time, right place. At that time, we thought we were very good, and that's why we are getting, promoted. But and it was not just me, a bunch of us. But now that we know that we just were very lucky that we were in the right place at the right time. So I think luck also plays a very important role. And the opportunity kept coming along the way. And then by the time, we were into 7-8 years of my journey, India by then had started transforming quite a bit. We had the .com period of the 2000s, and retail became a big opportunity as ICICI saw it. We entered retail, business started growing, business started expanding, we went international. So there was suddenly not just shortage of people at leadership levels because of the retirement program. There were 2 such retirement programs in the initial few years. But also the growth was coming. So growth plus absence of senior people meant that youngsters were getting chances to occupy bigger responsibilities. And that's what happened. So I would say we just kept, at least I kept pursuing the opportunity that came along the way, kept growing and stuck on. But I must tell you that it has been very, very enjoyable, very, very enriching. There's been a lot of learning along the way. And that is what really has kept me going. So I would say that, and it's not been all, hunky-dory along the way. There have been lots of places where I had to fall. I had to, literally cry my heart out that, I'm not getting what I was wanting. But when I closed my eyes and thought about it, I thought that, okay, even if you're 7 or 8 out of 10 in terms of what you aspire and what you're getting, it's still fine. You're not never going to get a 10 on 10 anywhere. So you have to get real about your expectation to an extent. You have to also be patient because it's not been all smooth throughout. And I would, if the younger audience in the unit today listening, I would say certainly follow your heart, do what you like, ensure that you're learning. Just ask yourself the question if you're in a setup which is recognizing professionalism and not really having biases. Most organizations, professional organizations today, have that kind of a culture. And if you're learning, be patient, stick on. And you really don't. And you really won't know what you're going to get in return. You'll probably outclass yourself.
Yeah. So Vijay, very well put. I always say whenever you start something, you feel I'm not going to be able to do it. And then one day it just seems like a back of the hand. It's like driving a car. When you first get into the car, I'll never be able to drive it. And then one day you're driving it at the back of your mind. But, loyalty is definitely a gene. And, a lot of wealth managers ask me this question that I've been a wealth manager for 15, 20 years. Why am I not doing great? You say wealth management is the best profession in the world. But why am I not? Because you have changed 8 jobs. You have lost your client. You're building a client book. You're losing a client book. And at the end of the day, our business and our, corporate is all about relationship. My father has a beautiful saying. He's saying, can you see luck? Most of the people say no. He says, yes, you can see the luck. Luck is having an opportunity to work in the right organization. He tells the story of Mahabharata. He says, who's the most ethical person there? People say Yudhishthir, people say Arjun. He says, no, it's Bhisham Pitama. But he's not considered to be the hero of the story because he was on the wrong side. So it's, getting an opportunity to work in the right organization, guys, or is what luck is. And then sticking to it is what you have to do to be able to this thing. And an organization will, respect you, and there will be ups and downs. It's never a smooth path, but you have to be persistent, you have to be patient, and you have to be loyal. Okay? And that's how you build a great career. So Vijay, now coming to our topic of the day, so we want to talk about stocks. People are super excited about stocks. When you talk about investing, you talk about insurance, they'll say, Acha, I bought an insurance, I bought a mutual fund, has slightly more excitement. But when you talk about direct stock, that gets people's heart pumping. So just tell us something about that. How should a person, deal in direct stocks? And, it obviously needs to be a part of the portfolio. But, how should he do it in a right manner that he is able to use it to actually genuinely create wealth?
I think that's a great question. I would say this is a very serious, wealth making is a very serious business. It cannot be dealt with completely at your gut level. There's a lot of discipline behind the effort. There's a lot of learning behind the effort. There's a lot of hard work that you need to put into back up, your investment thesis, investment plan. So first and foremost, I would say 2 things about wealth creation. It is a serious business. It is a business that requires solid commitment, discipline, and it's a business that you have to take it extremely seriously. It's a business where you'll have to be patient as well. Again, patience is something that I find many investors not having. They want a return tomorrow morning, and then they start doing a bunch of stuff and then not going anywhere in the process. So, on the back of these sort of areas, I think one should look at stocks. Even though, we offer stocks as one of the prime offerings on our platform, you would have noticed that over time we have made ourselves a far more broad-based player, and stocks is one of the things that we offer, because we do believe that for true wealth creation, asset allocation is very important, where stocks should form some part of your story and cannot be the whole part of your story. Therefore, people who are serious about looking at stocks should consider it, this kind of an approach. When it comes to stock, I would say important. I'm not a great fan of traders. Although in the recent times, trading has got the imagination of the young India in a big way. Some of you would have probably seen a report from SEBI some time back, which pointed to the fact that 90% of people who trade land up actually losing on the losing side. Clearly, it is a business which probably pumps up your adrenaline, but doesn't really pump up your wealth. So one has to really look at that with a pinch of salt. What we've also found is traders tend to have a short shelf life. Rarely do you find a trader surviving 2 years and beyond into the market. So it is a high burn rate. It turns out it can actually create to a dislocation of your mindset towards investing and saving and wealth creation itself. So please be cautious. As a trader, I would never recommend a youngster to jump into trading unless he really, really understands that world, and he understands that what he has earned can actually just go away in a day, literally. It is very volatile in that context. When it specifically comes to stock picking, I would say allocate your whole, I would say, amount first partially towards stock as an asset class. You need to have something towards fixed income, something towards, I would say, advised assets. Broadly, I'm using the word advised assets, which belongs to the world of mutual fund in a very loose sense. Direct stocks is something that should just about be a part of your portfolio. And as far as direct stocks is concerned, even there, you have obviously mid caps, large caps, and some small caps in which one can invest in. Today, there is enough and more research that is available. So when you're doing your investing within the allocation that you have decided for the large caps, for the stocks, have a good amount depending on your risk appetite, risk profile, your age, a good amount of allocation towards the larger caps, some amount of allocation towards mid cap and small cap, because that's the riskier in the more volatile section. But it also can land up giving you higher returns if you've got the right sort of stocks that you have picked. Follow research. You can do a top-down based thematic identification of a stock and then meet the bottom-up research within that larger theme. Because I do believe that if you are part of a larger thematic story, identifying a winning stock within that larger thematic story is a good way to think about stock picking. For example, today, we do believe the economy of India is going to grow well. There is going to be a good amount of capex, which is coming along the way. Government's capex is actually in a good shape as we speak. And therefore, what are the sectors which could do well in the context of a elevated level of government capex? I think the answer would boil down to things in the domain of capital goods, some in the domain of items like cement. There's been a benign environment globally as far as commodities is concerned, so there has been an adjustment of input cost as well. So in the immediate medium kind of a scenario, this sector looks good. Then having identified top down, look at bottoms up, which are the winning companies within the story. So that's where it gets into analysis of business models, competitive positioning of the company, demand supply equation in the micro market that company is operating, that kind of an analysis. So it is hard work. A lot of information, a lot of data would be required. And to assist that, research reports are available, right? You have many analysts providing these kind of research content. So leverage those research contents, verify your, sort of corroborate your theses, and then take a investment call. Once you have taken an investment call,
you've actually answered a lot of questions that people are asking. So, but let's do it sort of a piecemeal so that people can, get a chance to digest it better. We have one of our regular viewers, Suraj Sahu, who's asking these questions that how do political and economic developments in India and globally impact Indian equity markets, and what strategies can an investor use to navigate such events? So basically, asking in a more simpler this thing that today Indian markets are affected by global clues also. Okay, so how can you build a portfolio that's more immune to that? I have my own views on this, but first I'll let you answer this question, and then probably I'll add in a little bit more on that.
Sure. No, so clearly, uh, politics and global developments have a big impact on equity. No questions about that. And to say that you will be able to be immune to global developments and you will build a portfolio which is sort of devoid of risks associated with global factors is probably at best wishful thinking, because you could probably select ones which are mitigated to an extent, but to eliminate the risk would not be possible. So you need to recognize that these are risk factors associated with investments into equities directly. And I would say in the current context, when you look at both these factors, at least the political factor today, by and large, looks in favor of markets. As far as the policies are concerned, they tend to be very development focused, spend focused, pro growth. We've seen that through the last few years, despite very difficult scenarios, they managed the macro situation extremely well, while ensuring that the difficult sections of the economy don't completely fall off. They are supported. So I think a very good balancing job has been done to ensure that the engines of economy do well. And that's probably the reason why the current political policy framework has ensured that India is amongst the fastest growing nations, even despite enough and more challenges globally. Global factors, particularly what's happening in the US, has got a direct impact. We've seen that inflation has been very sticky globally, and that's been impacting Indian stocks in a way indirectly because of tightening, because of interest rates which have gone up, and in tandem, Indian interest rates have also gone up. Inflation has also been elevated beyond the RBI's tolerance levels. In a context like this, I think one can use. There's a strong belief clearly that equities are going to be excellent from a more medium to long-term perspective. One has to navigate this period with patience and use opportunities of economic headwinds to build long-term positions, long-term portfolios, and build a great portfolio. I think, for example, the last 1 year would have given us enough chance and enough opportunities to build a portfolio. And if one were to look at, even from a 1 year past time frame, 3 years hence, 2 to 3 years hence, I think one would be very happy with what really has happened with their decisions taken last 1 year and currently as we speak, because the next couple of years I think should be quite positive for the equities in the context of the current and the last 1 year situation. So I would say build a portfolio on fundamental analysis which would withstand, would have a competitive edge as economic situations globally also improve. They will get a sort of a kicker upwards. Political situation, as I said, has been by and large stable, and therefore sit tight through this period to build a good quality portfolio and be patient through this periods of economic, global economic difficulties, and reap the benefits once this period transits into the better global environment position.
Yeah, I think very well said. Let me just, guys, give my own views. One is that, you need to be concerned about this when you are into trading. And trading itself is a risky business. Last 2-3 years, companies are doing very well and they're showing humongous profits on trading. But is that going to sustain? No. Because what happened is that the markets were only on a one-way street. So, in 2000, they crashed And by the time people were free and they started trading, everything was going up. So there's a Hindi quote, "Gada ghoda ek barabar." So whether you were good or you were bad, people were making money, and they got this lot of confidence that, look, this is nothing. I am amazing. I can do it. But this is what happens. This is like वो बोलते हैं ना, beginner's luck in gambling. That when you come in, there is luck, 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 and your bets keep getting bigger, bigger, bigger. And when you have problems of these, the like what we call these, couple of days in probably year or 2 years, where markets will crash and people have such large exposures that they'll lose everything. So you have to be very careful about that. And this is a long-term game. And now coming to our next question, which is asked by Tejas, which is a beautiful question. That, okay, I want to get into stock trading, but how do I identify undervalued and potential investment opportunities in the Indian equity market? So how does a common guy do it, Vijay?
Yeah. So I suppose you're referring to stock investment and not stock trading. I want to
Yeah.
specifically.
So this question is about investment. That's why I'm saying it's a beautiful question. And if we can just explain to people what's the difference between trading and investment, that'll also be great.
Yeah. So again, I'm sure many would be already aware, but trading is more done with a very short-term perspective of trying to take advantage of near-term, I would say, technicals and near-term sort of developments in the environmental landscape. Typically, it could be done with an intraday perspective or short period of a few days, generally extended. Typically, they don't extend beyond a week. You, of course, have people carrying slightly longer term trading positions, but certainly very, very few people tend to do it in a longer horizon beyond 30-day period. But that also is in a minority. Investment, on the other hand, is more from a wealth creation perspective. It is done with a much longer term horizon. You should ideally be having 10-15 years of thought process when you think about investment, and not think of it even in terms of 3 years. Yes, you could look at a 10-15 year horizon, but start thinking of it in windows of 3 years as far as strategy. Maybe you can make a 3-year window strategy and then review it along the way as you keep going forward. So fundamentally, long-term versus short-term, I would say, is one big difference. And because of the nature of this approach, I think the kind of study that you need to do about stocks would also be very different. As a trader, you would be looking at charts, you would be looking at technical position of the, whether it's overbought, oversold, and then taking a call. Those things become very much less relevant when it comes to investment. It is more about business model. It is more about industry trends. It is more about growth rates. It's more about the moats that the business has created. It is more about the sort of competitive advantage he brings on the table, the sustainability of that competitive advantage, the profitability, shows the growth rates, the competitive intensity in that industry. All these factors become much more relevant. And only when there is a strong belief that this investment company has got in many of these factors ticked off, would it actually meet a cut for meeting your investment. And then there is this question which actually in a way directly refers to the point that you've asked: undervalued, right? Now that's I would say, a bit of a tricky element to determine. You just, there's a bit, I would say there's a bit of a judgment also in some sense, some way involved in determining, because what you may believe is undervalued, somebody else may turn around and say it is not undervalued because of some other reason. I would say there is a mathematical determination of undervalue, and then there is a overlay of judgment that one needs to do to determine whether that mathematical outcome is indeed can be concluded as overvalued or undervalued. Mathematically, there are ways to determine. When you look at PE multiple ratios and compare it with your peers in that industry or industry averages, you will get a sense mathematically. But don't get too carried away saying that this is a low P multiple, whereas the industry average is so much, peers is so much, and this fellow is only at a lower level, and therefore it's a great company, undervalued company. You will be sorely disappointed if you apply a mathematical equation. That at best can be used to shortlist a company to say, hello, can I have a deep look at you? And then you try and understand why is he at a lower multiple compared to peers, and you will probably get some answers as to why this company is indeed at a lower multiple. And if there are instances, of course, that the company is going through a kind of a transition and the market has not fully recognized that transition, and therefore it is waiting, to watch whether indeed that transition is going to happen, and then you take a judgment on the basis of what the narrative or the strategy is, and the belief and the confidence that you have in the management's ability to pull off that transition, that can actually make it move from its undervalued position to actually achieving true valuation once that transition is complete. That's one way of looking at it. So I would say looking at factors, using mathematical models to shortlist a company, and then applying judgment and study and taking a call on the strategy, and then determining indeed whether the company is undervalued, and then probably taking a call. That's one of the ways.
And Vijay, I'd like to add, look, there are two types of companies. One is value and one is growth. Okay, so when you talk about undervalued, then you're only talking about value investing, and there are value investing funds also. So point is that, but the returns only doesn't need to come from a value stock. It can come from a growth stock also. Growth stocks are the stocks which are considered to be very exciting. They are highly valued, but the company is growing at a very fast pace. Okay, so at the end of the day, it's a bit of a perception. What I like to tell the investors who trade in stocks, that mostly do it in the stocks that you have enough research out there. Okay, and you can see the research, you can take a call. And it's not an easy journey. Like, I had personally built up a portfolio of 5 stocks during the lockdown because I had more time. So out of which 3 have run up. Okay, because I believe these companies will do a great transformation. They will, and they have done really well. 2 of them have just stuck to where they were or even have gone down, because there have been things which have been beyond their control, or that transformation doesn't work out to be as quickly as possible. And I have almost so much research available. I have so many research people available to me. So, so it's not that easy. So if you want to do it, then be an informed investor. You can learn to read the metrics. There's a lot of now good programs available on stock trading and how to understand stock trading. Do some of these programs, and then be an informed investor. Don't take very short calls, take long calls, and try to stick with companies that you believe will truly outperform or win in the market, and that should help you do well. Okay, so now coming to the next.
Sanjiv, I'd like to add one point to what you said. I think you've said it extremely well, and that's where beyond the point there is an element of judgment, and that element of judgment will play out if the company indeed executes well. Because you hear a theory, you hear an approach, you hear a strategy, and then that strategy actually has to be implemented, and success will come, valuation will get re-rated, if and only if that execution happens as per what is intended to happen. And many companies we find are having a great plan, great thought, great strategy, but poor execution, and therefore value realization does not happen. So
I think
the ability to execute becomes very important.
Yeah, ability to execute, and so this is called in our terminology betting on the horse or the jockey.
Yeah, exactly.
Because the horse is the company, the environment, and jockey is the person driving the company. So it needs to be a combination of that, unless it's a monopoly like a petrochemical, where if the market is going to go up, then everybody is going to do well. So you have to keep that horse and jockey in mind. So there's another very interesting question by a young girl called Yamini, who's saying, how can I evaluate performance of my investment portfolio, and what metrics should I use to measure my returns? So this is a very interesting question. Now people say, look, I've got 13% or 14% or 15% in the last 1 year or 2 years or 3 years. Have I done well? I think I've done well, but how do I evaluate it? That have I done well? Have I not done well? So Vijay, how what would you like to say here?
Yeah. So again, I'm glad that somebody is asking this question because while many people invest, very few people really want to be sure that they are actually doing well by a generally accepted benchmark. And here I would say, one way in which, let's say, mutual funds or portfolio management schemes of fund managers evaluate themselves is they typically benchmark themselves against the objectives of the scheme. So first and foremost, Yamini, what is the objective of your investment approach is something that you need to define. Without complicating and overcomplicating it, I'm assuming that you're basically looking to get a kind of an investment out of a bunch of stocks that you have invested. So I think a Nifty could be a very good indicator. During the period of your start of the investment till the point where you're evaluating, study where the Nifty was, where the Nifty is. And if you do find that you have Nifty has moved by 12% and you're at 13%, you should tap yourself on the back. If on the other hand, you're at 13% and Nifty is at 15%, then obviously you have done all right because you earned something. But please remember that had you just simply put your money in Nifty, you would have probably earned a little more. So in that context, you have underperformed the Nifty. So clearly there is merit in, trying to improve your investment skills in such a context. So I think that could be one very simplistic benchmark of evaluating yourself. If you're not in the large caps, then you have the other indices. You don't have to be too harsh on yourself. You have the Nifty, the top 200, Nifty 200 and 500 and so on and so forth. So depending on the genre of stocks, you pick up that indicator and then you measure yourself against that.
I hope that answers it. So it depends on what you want to achieve. Okay, so at the end of the day, I like to say that you should benchmark your against at the top 50, top two quartiles. Like if you're going for large cap, you should look at the average return of the top two quartile. That means top 50% of the large cap funds. And if you've been able to get that, then you've done a great job. If you've got less than that, maybe you need to review your portfolio with a good wealth manager more often. And that's what you should look at. And that's how you benchmark how the person is doing for you. Okay, now the next question again is Parth is asking what should be the ideal asset allocation for a risk averse investor and how can it be customized based on individual circumstance. I have a very cheat sheet here, and I take it from Vijay's colleague, also from ICICI True Asset Management. Nimish has a very nice quote. He says, whenever you're confused, invest in balance advantage. So I'll say that, look, whenever you think you are risk averse and you want a good return, and you want a decent return, invest in a balance advantage fund, good one. And because that will do probably, so there your debt is up to 35% now, and remaining is into equity, and the fund manager is moving you between the two depending on the market circumstances. So I think it's a beautiful product for a risk averse investor. Vijay, what something you like to add there?
Yeah, so absolutely. If you're risk averse, the focus should be more on capital protection, and I think a balance advantage investment style fund really does that pretty well. If you're not wanting to go through a fund and wanting to go through directly, then first of all, informed chahiye. Please keep yourself properly informed. Good amount of your majority of your stuff should be debt side of it, and maybe about close to 60-65%, and the remaining 30-35% can be more towards the larger sort of end of the equity, the top 50 companies or top 30 companies, whatever. I think well-researched top 30 companies may not more than 30-35% of your investment, and 60-65% goes there. The other interesting product could be also the asset allocator. That's another one. If you have a longer term horizon and you're a balanced kind of a risk person, even an asset allocator kind of a model is an interesting model to evaluate.
Yeah. So that's very well answered. Now, another very interesting question by Mayur Kashyap. He's talking about understanding tax implications. And here, guys, other day I did a talk for International College of Financial Planning. If you get a chance, see it. It is about what a wealth manager should be doing for his investors. Okay, and one of the most important thing as an investor or as a wealth manager is that you need to optimize your tax. Okay, so if you're paying higher tax, you're not doing anything great. So you need to optimize your tax, that you're able to reduce your tax liability and that use that for building a better future for yourself. So today, if you talk about debt mutual fund FD, they are fully taxable. So you will pay the tax as per the slab. If you're in 30%, you'll pay 30%. NPS is tax free up to 60% computation. But then get into the details, like so a balance advantage will give you a 10% tax, this thing, or a stock. So so you have to take that. You have to optimize your tax to build a better wealth for yourself, and in the long run, it will make a huge difference due to power of compounding.
Indeed.
Vijay, would you like to add anything
No,
here?
I would just say that recently the finance minister in the budget has simplified things for people. I think with the debt mutual fund, all the benefits of indexation is all gone now, so it is simple now. As Sanjiv just mentioned, your tax rate is on debt funds, fixed deposits are what the slab you belong to. You can do precious little there now. NPS, I think depending on the type of fund, there are some slabs that you can select to take advantage of. But the indexation benefits that were earlier available on the debt side has now been taken out. So that's the situation. But let me just tell you, as we speak, some interesting products are being proposed by the insurance industry to be more tax efficient, because in investments into less than 5 lakh rupees under a certain category of insurance still is completely tax free. So as we speak, we are in contact with some of the manufacturers of insurance products to come out with some very interesting debt side products, an FD style products, but from a 5-year horizon, which would be a completely tax free instrument.
So these guaranteed return plans are very, very good for risk averse investors.
These are guaranteed plans that we are discussing, guaranteed returns from reputed insurance companies. But the holding point would be at least for 5 years. But I think tax free for that period of time.
Another very interesting question from Sachin Kumar Rai. He's asking, what are the key metrics when we should look at when we are analyzing financial statements, and how to use these for decision making? So this is coming more from your lending days, but obviously it translates into your stock picking days also. So Vijay.
Yeah, I would say simple, classical fundamental analysis. You start off by looking at margins. You look at growth rates in the sales side. You look at the ability to sustain margins by looking at competition, and then look at once you look at the profitability ratios after all your expenses, including interest. Then you need to look at interest and look at debt cover, what kind of interest cover and debt cover ratios that the company enjoys. Lower the debt, the better from a salience of the company point of view. Higher the debt service coverage, the better it is from the company's fundamentals point of view. And then you look at return on equity, which is a very important measure when it is coming to investments, as to what is the ROE that the company is able to generate, with the kind of business that it is operating. And I would say once this kind of an analysis is made, it will give you a sense of few things. It will give you a sense of sustainability of the profits of the company, which is a combination of studying the financial statement and the business model in conjunction. And also studying the profitability in the context of the debt, and then making some estimates of the future as to how the future would look like in the context of the plans of the company and in the context of the competition intensity, and therefore how earnings per share will keep moving up, how return on equity will keep changing over time. And that would be giving you a good sense of the growth in EPS, growth in valuation that can potentially be expected of this company. This is how a classical fundamental analysis is done. You don't necessarily have to do this yourself, because we as through our research house that we have provide this information. You could pick up and borrow these research reports. You could pick up these research reports, study this. Analysis is done by the analyst. This is day in and day out job. And then you just have to sort of challenge the assumptions made, look at the assumptions made, look at the reasonableness of those assumptions, and then take your call based on what you see. Obviously, higher the growth rates, higher the sustainability expectation, lower the debt position of the company, typically, and the industry dynamics, the better the valuation.
Yeah. So guys, learn to read the research reports. If you're really getting into it, once you start reading the research report, this will, ease a lot of things for you. And other day I met an investor. He was showing me something. So, he cut and copied the research report into Chat GPT, and it says, tell me what it means. And it gave you quite a nice summary. So maybe today you have AI to help you, understand that research report too. Okay, so going to the next point is Anish.
But since you mentioned that, Sanjiv, I must say that over the weekend, I was actually trying to quiz this Chat GPT, and I asked them, please tell me which are the good Indian equity investments in large cap stocks. And I was actually disappointed with the answer, because they said, sorry, I'm not able to answer you. And then he started talking about US stocks. So I suppose the engines need to be trained for the Indian context.
Yeah, and directly it doesn't answer, but you have to, it's about writing the prompts. So, so they are trying to make sure. So, but what this person had tried to do was that he was uploading the research reports, and he was asking this question, what does this mean? So, I saw that it was giving a beautiful summary. Still, it was not giving any advice, but, it was giving. Okay, so now Anish is asking a very simple question that I've been saving for the past 3 years. Now I want to invest money in wealth creation. Please tell me whether I should buy at a dip or a starter SIP. So here, Anish, I'll say, whenever you have the money, start a SIP. So dip, you never know when it's going to come. And when the dip comes, you don't understand whether it hits rock bottom or not. So please don't sit on the side. If you don't play a match, you'll never win. If you don't run in a race, you'll never reach anywhere. So stop waiting, start by a SIP, and if you feel there's a dip, put in some lump sum from your FD or some other place. Also, now, yeah. So Vijay, I'll now go to a more interesting that you have made some statements. A lot of people are asking this question that Indian equities are going to do better than global equities. And a lot of these startups are, just marketing like crazy. Buy Apple, buy this, buy global equities. So they want to understand India versus global equities, which is going to do better and what should they do?
Yeah. So I'm going to answer that question. But before that, I'll just my 2 bits on that earlier question, Sanjeev. I've got 2 daughters. Both of them are just started their career. They've started working. So they are the typical Gen Z. And when they started getting their first paycheck, they said that, no, Papa, we want to start investing. We want to invest in, what do you want? What should we do? I said, you simply sit and start your SIP and buy mutual funds. Keep it simple. Don't overcomplicate it. Select some good large cap funds and, just keep going. I would, certainly believe that, I would advise you the same thing. Don't wait for any dips. Don't wait for any highs. We don't know when the dip is, when the high is. Just simply go and put a SIP and keep don't get perturbed when markets go down. That's one thing I always worry, because my daughters, when the markets went down, came running to me saying that you don't know anything. My investment is all down. I'm going to stop it. I said, please don't stop it. This is the time when you should continue. And if you have some more money, please increase your allocation. So today, when they've seen that the market has gone up, they are actually breathing easy. So again, I would say, don't get perturbed when you start your wealth creation journey. The moment you see some kind of a decline, don't panic. Just continue. Be at it. Just ensure you are with the right stock, right company, whether it's a SEP or an SIP, depending on where you are. Now, coming to the global, sort of a question, Sanjiv. I would say, that comment that I made was actually in the context of what's happened in the markets in the last 1.5 to 2 years. If you look at Indian equities since October 21, markets have been broadly sideways, at least at the headline level. Nifty to Nifty, if you've seen the last 1.5 years, it's been sideways. While we may think of it as sideways, in reality, what has happened is there is a little bit of a churn. Banks have done well and supported the index. IT has, sort of been badly impacted and it's gone down. FMCG probably has all supported it. So there is a kind of a merry-go-round within it. So while seemingly it may look that, markets are flat, actually there is a lot of churn. And then when you go even deeper into the mid-cap story, it is a lot of pain. Lots of correction has happened. So last 1.5 years, you've had not only time correction at a headline level, but also a lot of correction in the stock valuation below the surface. So in the context of its P multiples, we are in the ballpark of around 16 times. And this is therefore at, long-term trend, say, one of the lower levels from a valuation perspective. Secondly, when we look at where we are at this point in time, I believe that many of the headwind factors are in a way peaking, whether it is inflation, whether it is interest rates. We are probably near peaks. If not, the peak is slightly behind us. We will know only with the passage of time. So therefore, there is very little worry that we have in terms of what more is going to happen in terms of headwind becoming stronger. The chances are that by and large we are done or at the last leg of the headwind story. So from that context, I was thinking that valuations looking good, many of the headwinds are behind us. The next few, and then the medium-term prospects of India's growth story looking very, very strong. Earnings are looking quite decent. Banking system is impeccably clean. We probably never had banking system as clean as we have just now. So the ability to lubricate the system with credit is also very high. And therefore, growth should come. In any case, we've got a fairly strong policy support to growth. So there are many factors which are in favor of India. On the other hand, US, despite the tailwind, the headwind sort of coming to an end, there are questions around the potential, decline in growth rates to even a possible sort of a shallow recession happening in the US. We are reading enough and more about pain coming. I talk to a lot of foreign investors. There is a lot of pain in the local economy, which is probably still not getting completely reflected in the numbers. So there's a possibility that growth could come much suddenly. It could sort of have a kind of a downward trajectory, and then it's going to be a long unwind process of interest rates going down and the growth returning. So from that point of view, the uncertainty that exists more in the global markets than we are having here, I personally thought that this is a much better time to invest in the Indian markets than the overseas markets at this point in time. Valuations overseas had corrected, but if you see, I think S&P is back to about 4,000, nearly 4,100 if I'm not wrong. So it's not as if it is sitting with too much of upward gas there. India, on the other side, I think has got more potential given the factors that I explained, and that is why I felt that this year could be a year where focus on Indian equities could give a better return.
Yeah, so I 100% agree with that. I think Indian equities has much better potential going. Even I like to say in the next 1 to 3 years, because there is a lot of global headwinds the Russia-Ukraine war is a event that cannot be predicted. Uh, and it's causing a lot of strain on the economy, a lot of other factors and points playing out. So, whereas India, in that sense, that if you're in the right sectors, you're investing in the right sectors, there's a lot of growth. And in the Indian story has become exciting. A lot of capital will come to India. And India has finally started attracting long-term capital, the manufacturing capital, the more stable capital. So that is going to be a very exciting journey for India, and you should actually take a part of it. Last time we had discussed, like what Vijay said, Indian financial services stocks are quite well placed. The market has not been cleaner, so that's a great opportunity. Uh, you know, a couple of months ago, I had personally shared with you that I was buying into US tech stocks, and as Vijay said, they've gone up by almost 30%. So that whole growth that they had to show, and what worked well in the last quarter will not work well. And also keep in mind that we are living in a world of disruption. So what has happened in AI is actually a very disruptive moment in the history of the world that we are living in. It's totally going to change where things work. 2 3 months ago, people had not heard about AI. Today, you cannot live without AI. And let me tell you, my own personal productivity has gone through the roof. What I needed people to do, today I'm able to do it much, much more easily. And there's so much, and every day there's 10 new tools, and the kind of productivity of the teams who are using these tools. So it's going to totally change the way, and we have to understand Western markets adopt these tools much faster than us. So we are in a disruptive, so it's better to be more careful, and we're very, very careful, especially when investing in the international markets. So there are a lot of these questions on employment and working for Vijay or me. So for Bajaj Capital, we are very simple. We have a tie-up with the International College of Financial Planning. We have a program called IDWM. You can look it up, because I don't believe starting and working in financial services without doing a CFP or having a proper knowledge, you're going to be a successful wealth manager. Yes, maybe one out of 9 will succeed, 1 out of 10 will succeed. But if you do something, you have a 8 out of 10 will succeed. So do this program, and you can come and work with us. If you already have an experience, then all of us are looking to hire. So there's very easy way to get information on us. So I know we are out of time and we're running. So Vijay, one last question I wanted to ask you, and there are a lot of people asking this question on ICICI Direct as a stock. And they are saying that, look, there is an ICICI Direct, there is an ICICI Bank. So, how do we look at ICICI Direct as a stock versus ICICI Bank? Do we look them as a bundle? Do we look at them as a separate? So lot of very interesting questions. So I'm just summarizing because we are out of time. So just,
yeah. I'll try to be brief.
Question a lot.
I'm sorry?
I'm saying I'm sure you get this question a lot and you understand it.
All the time, yeah. So I would say ICICI Direct, the listed entities called ICICI Securities Limited, and ICICI Bank are two independent, different companies, I think, from that point of view. One is a bank. It has a different industry dynamics operating on it, and therefore very different from ICICI Securities Limited, which is in a non-lending financial services space, including wealth management. So they are vastly different from when you double click into the industry dynamics. The dynamics are very, very different. So not at all comparable. The only difference, the only similarities or commonness is the fact that ICICI Securities is 75% owned by ICICI Bank, and only 25% of the stock is free floating. Clearly, it has, given the fact that it is independent, it has its own dynamics, has its own, I would say, valuation multiples. You have to look at it as two very different entities and don't get confused. It has a single stock. We have seen last year our stock do extremely well before the market started tanking. I remember when I had joined ISEC about 3.5 years back, the stock was in the ballpark of around 200 rupees a share. we've seen close to a 900 rupee stock price, sometime in the quarter 3 of last fiscal year. I'm talking about the 22 fiscal year. And then when, Putin, Ukraine happened, markets were weak, market sort of has declined. Over the period of time, we have diversified as a house quite a bit. Our dependence on equities has come down. To give you a sense, 3 years, 4 years back, 65% of the revenue of this company used to be cash equity and equities. Today, that number is below 35%. And during the last 3 years, our revenues have doubled. So there's a big diversification that has kicked in. And I think, therefore, we are well positioned. Last year has been a tough year. We have used that year to improve market shares across. So it is really to see, as markets improve from here, how the company reaps benefits of the cash generating capabilities that it has generated over time. I'm giving you whatever I spoke about. The stock is all publicly available information. It's all available on our website. We have very extensive disclosures that we give. You can, if anyone is interested, download and see our investor presentations on ICICIsecurities.com.
Yeah, and guys, let me just summarize by saying, look, wealth management is a very exciting place to be. Like, what happened is that during the COVID lockdown, a lot of people got into stockbroking. Now they are graduating from stockbroking into wealth, because there are two types of people. They are bargain hunters who don't want to pay a price, and there are people who are willing to pay a premium for a premium service. And here, as I've explained in the past also, premium is not too much. You pay 0.5 to 0.75% to a wealth manager or a wealth management company to help you manage your money. And if they do a good job, they should actually get you a 2% or 1.5% extra, because they help you manage your money better. And what we are saying, at least from us, that client acquisition today, it's more of a problem of being able to manage your client. There's so many people who want to upgrade from being traders or buying or direct, today into getting advice. So there's a huge potential. So I think our industry is very well poised for growth. There are going to be a lot of consolidation stories. There's huge exciting. I think we are living in a very exciting place today, and our time in history is there. So I'm actually endorsing your stock, Vijay, but so I may personally buy it. So point is that I think I'm a firm believer in Indian financial services and wealth management at the moment. I think it's in a beautiful position at the moment. And Vijay,
Yes.
thank you for coming in today, and thank you to all the viewers who came in. And we had more than 6,700 people watching us live. And thank you for taking out times. And generally, our views go over 1 lakh in the couple of days. So thank you for the people who watch it. Vijay, some last words from you.
Thank you very much, Sanjiv. I think I really enjoyed having this chat. I do hope some of the responses that we discussed, some of the areas we discussed, were helpful to our viewers and listeners. Please do continue to follow our journey, continue to follow our story. We are there on Twitter. Follow us on Twitter as ICICI Direct handle. We also come out with good updates on the Telegram channel. So go to Telegram, download our, search through ICICI Direct. That's another place where you'll keep getting market updates if you're interested. And because this is an exciting area, and every day you get updates, developments, news, views, which will help you in your wealth creation journey. So our effort is to, just like your company, Sanjiv, to partner with our customers in their wealth creation journey.
Yeah. Thank you, everyone. Thank you for joining us today. And please be there for our next series of